AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines.
Bay Area real estate and mortgage experts with over 25 years in the business.
Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome in. I'm Tony Mendez.
And I'm Gordon Hines.
This is the Real Estate Report on AM 1220 KDOW. Thanks for joining us today. This is a live show. You can always call it 800-516-1220, 800-516-1220. And you can always email us, Tony or Gordon, at bayarealoansource.com. So we are live, and we are talking mortgages and real estate. So if any of those topics appeal to you, which, Gordon, I think a lot of people, if you're renting, you want to buy. If you're an owner, you want to kind of figure out what direction the market's going. Right now, the biggest topic is inflation, mortgage rates, gas prices, food prices. Everything's just getting more costly. Interest rates right now, according to Freddie Mac, 3.85%, according to their weekly survey that Freddie Mac does. The 15-year at 3.09% and the 5-year ARM at 2.97%. Yeah, there's still rates you can get below 3%. You got to get an ARM. We've done a couple segments about ARMs. I put a nice video on YouTube. You can go to check that out at Bay Area Loan Source at YouTube. But it's all about the cost of money right now, Gordon. Do you still feel pretty good? Knowing those numbers where we have like $275 billion in equity withdrawal in 2021. Do you think that's going to continue? People seeing that money, that interest rate as the cheapest way to get money, especially as we keep seeing these home prices and equity growing?
Well, hopefully, I think if I'm a betting man, I'm hoping that people have seen the writing on the wall, seen this coming, and that's why all the withdrawals. A lot of people out there sitting still on a lot of cash. That's one of the reasons why the real estate market is so healthy, because there's people out there that have an abundance of cash. In the last couple of years, stock market has made a lot of millionaires out of local people, especially with Robinhood and a lot of the kids that are involved in it with the with the phone apps and everything else. So it brought a whole new agenda of wealth into the economy. Typically, when we looked at wealth before, we looked at wealth over time, but with apps and all the new programs and everything else, you look at a lot of millionaires on this slate right now are young people that have actually found a way how to capitalize on technology and capitalize in the market. The biggest concern, of course, is inflation. People are jumping up and down about it. I heard today that it's the highest it's been since January of 1981. I remember back then, of course, I think the rates of CDs were paying probably like 5, 6, 7%. So interest rates was probably around 8, 9, 10% as far as the market is concerned. So conversely, if you compare that time frame, what's that, 30 years later approximately to now, where interest rates we're in the high 3s to low 4s, depending on your credit score, depending on loan to value, depending on conditions of rate. I think we're still ahead of the curve if you look at that, if that's a factor. But of course, cost of goods purchase, of course, is very important. But money going a lot less. Listen to a cab driver this morning. He spent $100 more on fuel a week than he was, a month ago. And every day prices continue to go up. So it is a concern for most Americans.
About 2 years ago, as we saw home prices start to rise, we saw less expensive homes a little further away. I did an analysis on how much more you actually are spending by buying a house that's farther away from your job. So I just took the average commute times the amount of gas per week, per month, and I turned that into a loan amount. It's like $50,000 or something like that. Now we got to do that with gas prices going up. If you're buying a house farther out, it's not just the price of the home that's going up, and the rate's going up, but it's the gas to get in. Are you going to commute? I did something interesting, and I get 34.5 miles to gallon in my car. I wanted to see if I could squeeze out a little bit more. I've actually turned that into 37.8 just by my driving habits. I'm not going to tell you how I did it. You can always figure it out, but there's ways you can do it. I calculated that comes out about 35 cents less I'm spending on a gallon of gas now than I was before when I was driving 34.5. And it wasn't just the math about it. It was that I'm starting to think this way. Are you thinking that way yet? We have inflation, we have higher interest rates. Does that translate into everything else in your life?
Well, I think turbulence always causes us to think different. It causes us to reevaluate what we do and how often we do it. The biggest difference is, of course, if you compare now, buying distance from work versus having to commute to that job 5 days a week versus 2 or 3 days a week. I mean, that's a substantial savings if you don't have to commute 5 days a week. If you move far away from your place of employment to a domicile to get affordable housing. So it's a balancing act, of course, and the pendulum is always swinging left, right, sideways, and we just got to find a way how to work through these circumstances to find out what balance work for us. And sometimes we find out that all the balances that were working before that we thought were ingenious, now we see that how obsolete they are now that we're thinking a different way, looking at it in a different standpoint of how we see it, and it kind of really, really can impact your wallet.
Well, rates aren't looking like they're going down anytime soon. Sam Cater, the chief economist at Freddie Mac, he said that over the long term, we expect rates to continue to rise as inflation broadens and shortages increasingly impact many segments of the economy. However, uncertainty about the war in Ukraine is driving rate volatility that likely will continue in the short term, which, we're going to see that. We saw a dip earlier in the week, and then it went right back up. And we saw applications rise, and then they went right back down. So we are going to see those opportunities, Gordon, along this volatile period, especially going into this buying season. I think the buyers right now are kind of like really on edge. They don't know what to make of where rates are. They're hearing rates in some cases over 4% for the first time in a long, long time, and they don't know what to make of it. But those opportunities where the rates dip, ebb and flow, if you want to call it that, offer good opportunities for people who feel like they've missed the opportunity to refinance, or they just need to refinance. We've done some videos on why to refinance. There's many reasons why people refinance. It's not just to lower your rate. So as these opportunities present themselves, you should be ready. You should watch it. Freddie Mac Weekly Survey, it's called the Primary Mortgage Market Survey, is a great place to go. You can always go to our website or email us. We can always keep you up to date on that as well. But seeing these opportunities, Gordon, I know that you've grabbed them. You've done some grabbing. We've seen people doing cash out. We're going to talk a little bit about how much cash out people have been taking. The mortgage equity withdrawal is in 2021. We saw huge amounts of money taken out compared to 2000. What's interesting though is when you look at those numbers, the debt ratio, what people would they take your payment and divide it into your income, so to speak, and that right now is at 27.4. Back in pre-recession or the Great Recession, that was at 31. Do you think we have a little bit more room to get higher on those debt ratios, Gordon? The average debt ratio, that is. Well, what people are spending of their income.
Well, as rates go up, you will see that debt ratio coverage go up, of course, because if you're looking at comparing a rate, let's say a year ago at around 2 3/4 on a 30-year fix versus now average 3.8, which is almost 1% higher, of course, that's going to push your debt ratio up. So once again, it's a balancing act. I still think we have some room. I don't think it's time to hit the panic button. Once again, if you're looking at a 30-year fix at 3.75, that's still a great rate for 30 years if you look at it. But if you're comparing it to, a year ago at 2.75, of course, it seemed higher. But as we know, we always be concerned about the sign of the time is not what it was and what it is. And we also have to make our decisions based on what it is and not what we think is supposed to be or what it was before.
Interest rates, again, we're talking about how it's impacting everyone and their decisions to buy and to refinance. The National Association of Home Builders, they have their 2022 priced out estimate, shows that 87.5 million households are not currently, at current rates, are not able to afford a medium-priced home, and that an additional 117,900 households would be priced out if the price of the home goes up only $1,000. But they also did another analysis saying that if the interest rate goes up a quarter, 1.1 million households would be priced out. And they go on to throw this chart all the way up to 9%, quarter at a time. And it's about 1 million each eighth or quarter. Each quarter. And so we're starting to now see that is really impacting not just the people who want to refinance, but the people who want to buy. We're with low inventory right now. We're at another record low in inventory. What happens if inventory starts hitting the market a little quicker? We've talked about this over and over and over. Where's it going to come from? Where are the sellers going to come from? Please sell your house. We're hearing a lot of realtors say, please, please, please. We're getting more and more phone calls, Gordon, to sell houses. I've sold a house 7 months ago, and I still get phone calls for this house. There's people looking for inventory desperately, Gordon. What happens if more inventory hits the market?
Well, I think more inventory will hit the marketplace because the market is about change. I think what happens is we get locked in on something, and then once the lock is unlocked, I think we start to panic. We always talk about one of the reasons why we've had this great success in the real estate market is basically supply and demand. There was more demand than there was supply, and naturally, if you understand economics, more demand, less supply is going to lead to higher costs. We always talk about the magic number that we talk about here in our businesses, here in this office, and on the airways that we speak every week, is days on the market is a key economic indicator of an index of what the market's actually doing. We are in what we call a lag economy, meaning that when we look at sales, we talked about this last week, we look at sales and those kind of things, everything is based upon past. So those numbers that you just threw out from the economists from the National Board of Realtors, of course, is looking at lag economy, meaning that these numbers are going to change as rates continue to rise. And those are the things that we have to project. Those are the kind of things that we have to keep in balance and kind of really refocus our thought process when we are out there looking to purchase a home.
Everyone has to. Yeah, everyone has to keep an eye on it. We talked last week or the week before about what happens to home price growth after interest rates go up significantly, that is. And there is a lag. It's between 4 to 8 months before it actually starts hitting that growth rate. The lowest we saw since 2012 was 4%. That's still year-over-year growth. Was 4% was the benchmark, and everything else has been above that, even in the times where the rates went up. But it took 4 to 8 months before growth slowed down. So it is a lag market right now. We're at the beginning of it. Rates are up. Home prices are hitting all-time records. Home inventory is low. Days on the market is at an all-time low. Everything is, lagging from 2 or 3 months ago. We're going to see what happens. We'll come back after this break. You're welcome to call the show 800-516-1220 or email the show Tony or Gordon at BayAreaLoanSource.com. We'll be right back.
Questions about real estate? Call the program 800-516-1220. Now back to the Real Estate Report on AM 1220 KDOW.
Going back to the Real Estate Report, I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
This week marks the 2-year anniversary of the coronavirus pandemic, according to the World Health Organization, when they officially declared a pandemic on March 11, 2020. Here's some of the ways that the housing market has changed since then. House hunters, they have half as many homes to choose from, 49.9% down from 2 years ago. Homes are 34% more expensive, with the median price today, $369,000. Buyers are twice as likely to pay above list price as they face fierce competition. More than 2/3 of home offers face bidding wars. 2 years later, houses are selling twice as fast, with the typical home sitting on the market for 25 days. That's the days on the market we were talking about. Nearly half of those homes sell in just 1 week, up from less than 1/3 before the pandemic. So 2 years later is, when we first heard about the pandemic, or started really accepting what was going to happen, we didn't really think that was going to happen. If I told you, Gordon, 2 years ago that we were going to see a 34% increase nationally in home price, we were going to see over asking price on more than half the homes, and homes were going to sell twice as fast as they are, when we already thought the market was on how many cylinders? 8. Then it went to 10, then it's 12. What would you have said 2 years ago if I said that?
Well, I thought what happened was most people thought that
by the way, and rates went down to all-time lows.
Real estate market was going to do the same thing to the stock market. The stock market initially, in that first 30 days, lost 30-40% of valuation. People started panicking. Margin calls were coming in, and, stocks fell, to all-time lows. And then, of course, caught itself, rebounded, and started back on a stealth, way up. And in less than a year's time, it eclipsed all its losses plus another 25% gain. Most people thought the real estate market was going to do the same thing. Fortunately, it didn't. Real estate market did not budge because rates stayed down. A lot of things came into play. A lot of government programs came in. We circulated money through the market, paying people not to work or paying people to work, whichever way you want to look at it. And I think that's what kept the economy stable, which was the real estate market, and kind of worked ourselves through that whole, crucifix, because if that didn't happen, we might have been looking at another minor, mini depression if that didn't happen.
What stands out to you as the most surprising event out of the last 2 years from COVID?
I think that the way how we handle the announcement of it all, I think it was just it's like bad news. It's like the bad news bears. I think for some reason it kind of really got out of hand, and I think that if you're going back in time, of course, Monday morning quarterbacking, I think had we gone back and we could have handled the COVID a lot better, I think we'd have been probably lost a lot more lives, been a few less lives than we did, simply because I think we'd have been more prepared. I think, as you see now, there's still a standoff between mask, no mask, school, no school. There's 6 on one hand, my brother's favorite line, and half a dozen on the other, it looks like. And I think that's what caused a lot of confusion. And I think we lost a lot of lives because of that.
When it comes to real estate, what do you think is the most surprising thing out of the stats that we went through?
Well, I was really surprised that the market held its own. The market stayed up there regardless of, there were no open houses, but the market, once again, it reinvented itself, Zoom meetings, all those type of technology things really came into place. Had we not had a lot of these technology things, I think the market would have taken a big hit, buying houses on virtual tours. I think rates were still low. It's typical.
That's a big one, Gordon.
I think that's what really, really helped the market survive, and that really kept the economy up because, of course, the real estate is the biggest economy in our current marketplace.
Well, one of the things that I think we really undervalued was that we were in a position technologically to really do the things that we did during COVID, the remote viewings, the
work from home.
Work from home. Just, all of these things worked out for the real estate at this time. Imagine that 10 years ago. We weren't quite ready. It would have been disastrous in many ways. People wouldn't have reacted the same way. Personally, I see inventory as the biggest surprise. I thought we were going to see builders really take advantage of the demand. Builders, they like money. They really, really like money, and they really have their finger on the pulse of the buyers and the market. And I was really surprised to see that they didn't and still haven't really caught up. Now, of course, there's other reasons like supply and labor constraints and so on, but taking advantage over that period of time and just build. We saw it happen here in the Bay Area. It was one of the largest booms in multifamily housing, for example, in the United States during the early 90s. And why didn't that happen? Why didn't we satisfy the need of the buyers? Even today, single-family growth is declining again, even though we saw it come back a little bit last year, but it's still well below where it should be. We're seeing supply constraints. Building materials are expensive. We're seeing, red tape, slowly get lifted, but not fast enough for a lot of these builders that are looking for affordable homes. And we had a huge buyer pool that was just ready to pounce on any inventory, and they just didn't take advantage of it.
Well, I think
that was my biggest surprise.
Builders were cautious because when the pandemic happened, people were nervous. People weren't sure what was going to happen. So builders, of course, when you're going to build a development, it requires a lot of capital. It requires things to happen. You didn't want to go out there and build and put up all these homes and then nobody was buying and they go bankrupt. So I think that's the reason why they didn't kind of keep up with the times. And, of course, that was a knock on supply constraints, of course, and that actually eventually caused more and more prices to go up.
Inventory, I believe, will continue to play its part throughout this buying season that we're coming into right now. We're seeing some significant growth in pending sales right now. It's on track to what it was in 2020 and 2021. Well, this they say 2021 because 2020 was right when pandemic hit, but we're seeing the growth already in pending home sales for existing homes, but with the lack of inventory, it's still kind of anemic, Gordon. I still think it's going to continue to push up home prices. We are going to eventually see the lack of higher interest rates start affecting the growth. We just talked about how more and more families are being priced out by higher interest rates and higher home prices. Every quarter interest rate in hike is about 1.1 million families that are not able to afford a home.
I must say the hike has been a speculative conversation. As of today, the Federal Reserve has not raised interest rates up a digit above what it was from the last time it raised. But of course, the market is speculating. The market is thinking it's going to raise. That's the reason why I believe we've pumped in, an increase in rates on the marketplace, so that when it does happen, the market doesn't go up any further. I think these are all the things that always typically happen when the Fed do announce an interest raise. We'll probably see rates dip a bit because the market's already penciled in, and it's an overreaction to what you thought was going to happen.
It really is. They really do build in the increases into mortgage rates. It's when they stray from what they predicted where we see the rates go up or down. So we'll see that soon. That's coming up very soon in March. Whether or not the Fed's going to raise interest rates a quarter, 3/8, we don't know. But it's built into rates right now. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. You can always call the show 800-516-1220, 800-516-1220, or email the show Tony or Gordon at bayarealoansource.com. We'll be right back.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
You can always visit our YouTube and Facebook channels. It's Bay Area Loan Source, all one word, Bay Area Loan Source. And you can hit our website up, too, for more information. .com. So inventory, I think, was the biggest surprise for me. But looking back at it, we had the work from home mentality. People are looking for bigger homes. Single family homes, they really did well, and they're still doing well. That is the desirable piece of property that everyone's looking for, Gordon. That affordable single family home. We see a lot more investors or owners that are turning their single family homes into investment properties, because even though they're moving and they're looking at these it's perfect timing for these people who are moving with these low down payment products. They can keep their house, turn it into rental, use the rents to offset the debt on that departing property, as they call it. And all they're doing is buying a new house with some of these new programs that require less down payment. So I think that we're still playing with that. The haves, not the have-nots, the haves are doing really well and have a lot more options. We saw that stat about the older generations, the Gen X and baby boomers, that are just outperforming across the board when it comes to down payment, the age of the house, the winning bidding offers, and so on. These are the people who have owned homes before that are putting more money down and qualifying better. This trend is going to continue, I believe, and continue to squeeze out first-time homebuyers. What is your thought on how first-time homebuyers, and we just talked to somebody today who has a low down payment and couldn't meet the reserve requirements that some of these low down payment jumbo products allow or require. What do you tell these people that are looking to buy their first home?
Well, I think first-time home buyers are in a very challenged position to be in right now. As we talk, first of all, you have to come up with a down payment, which is, most people are working at the minimum 3.5% or 5% down. Then a lot of these programs depend on credit score, requires reserves. So you need down payment plus closing costs plus reserves. The gentleman we were talking about today, the program that we were looking at putting him in, by the time he figured out the down payment, the closing costs and reserves, he was actually better off mustering up more money and putting down more than the 5%, doubling his down payment, which would still have been a heck a lot less than using that formula. So it's a tricky position to be in. That's why you need somebody to really help you, navigate through that whole wave of information out there. That's why we're here. I think we do an excellent job of positioning you to become a homeowner. A lot of different products out there, a lot of ways to look at things different than how a lot of other companies look at things. And I think that's one of the good things that we do here and why we're so successful of helping people get into homes, especially people with limited down payment, challenge credit, those kind of things. We can really find a way how to work through. I think that's one of the great things of what we've been doing here for many years.
I agree. Work with the professionals. We are one of them that has options for you and have been around. How many recessions have you been through?
Many.
Many. How many ups have you been through?
Many.
Go with the people who know what it's like to go through these cycles, and you don't have to do it alone. You can always reach us, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. That's YouTube and Facebook as well. We'll come back after this break here on AM 1220 KDOW. This is the Real Estate Report.
Got a question? Run it past these guys.
800-516-1220.
It's the Real Estate Report with Tony Mendez and Gordon Hunt on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Welcome in, maestro.
Thank you.
So what is the market doing right now? Some of the data that we've seen, the median home price was up 16% year over year to a record high of $369,000. That's up 34% from the same time in 2020. We talked about that earlier. Some of the changes we've seen over the kind of a 2-year anniversary and the week of when the WHO declared this a pandemic. Monthly mortgage payment and the median asking price of a home rose slightly to a record high of $2,048 a month. That's at the current 3.85% mortgage rate according to Freddie Mac. That's up 22% from a year earlier. Can you imagine your mortgage payment going up 22%, Gordon, in 1 year? It's up 33% from 2020. So 33%, your mortgage payment has gone up. The average mortgage payment has gone up in 2 years. Home buyers are in a frenzy. Buyers are reacting to changes in the market based on mortgage rates that are going up, and they're unfazed by things like the stock market and Ukraine, rising oil prices. These risks are teaching us levels that could be dangerous to the economy. Do you believe in that statement? That's according to Deputy Chief Economist Taylor Marr at Redfin.
Well, I mean, everybody's entitled to their opinion. I think that's
a pretty good opinion.
I think that, once again, I always tell people like that are paid to talk and paid to speak. And, it depends on how aggressive you listen, whether you agree with the information or not. I think when you're outside sitting in, what a lot of guys do, they predict things. And sometimes I agree, and most of the time I don't agree. With that particular statement, I probably do agree.
Silver lining for housing is that the spike in mortgage rates has paused. Do you believe in that statement? Do you think that people are that reactive? I don't see people. When I wasn't interested in a mortgage, and there was some times when I could have dropped my mortgage rate and I didn't. I could have some money, a couple $100 a month here and there. That's a lot of money now. The gas is up to almost $6. Food is up 20% year over year. That's a lot of money. But I wasn't paying attention. Do you think people should, that own a house should pay more attention to the trends in rates and get themselves associated with a mortgage broker that can push a button when things look right for them?
Well, I think we do, but for the most part, we as human beings are creatures of habit. Things are only important to us when it's a reality. You can hear news about mortgage rates all day long, but unless you have a need or necessity for money, most people don't pull the trigger. They look and look and look and say, oh, they're going to go lower, lower and lower and lower and lower until actually, we're always trying to time up what we call pinpoint the marketplace. But I think that, once again, if it doesn't affect them, it's not a reality until, and it's in your backyard, to use that old cliche.
I think that people, look, this is about money, right? Everybody gets, they go to work for money. They go shopping, they have to spend money. Everything's kind of revolves around money. I've kind of changed my tune on it. I think people should spend more time, just like you do your taxes, kind of every year, review your mortgage, review, you do it. You're a professional. We know professional investors that are always doing something. They're either refinancing, not taking cash out, but fixing their income on the property, or taking cash out and leveraging it on another property. I think people should get more involved in real estate. It's the largest financial decision you're going to make for most people, and it can have the largest impact if you don't do it correctly or you don't manage it. And I'm in the business, and I felt like for a year I could have refinanced. Yeah, we were busy and we were making money, and it didn't feel like but I wouldn't mind $200 extra a month, or let's say $2,400 a year. It's still a lot of money, especially when you're looking at where you're saving it. The stock market was on a roll, and or you could have put it into your IRA and helped you with your taxes. There's a lot of things people could do with this money. Do you think that refinances are just going to dry up, period, for people for a while they sit back and figure out what rates are going to do? Or does it make any sense to say, hey, do it before rates keep going up? We see the writing on the wall right now.
Well, I don't think refinance is going to dry up. If we go back through history, we've seen this. I've been around for a long time, so I've seen these kind of changes in the marketplace. They don't dry up. I think the market does slow down. There's always a necessity, a need for money. As we talk, we refinance people at lower rates into higher rates simply because they need money in the house. Your primary residence, the cheapest place you're going to get that money. I think a lot of times, as going back to the statement you made earlier, one of the deterrents in talking to a lot of people about refinances, they think the paperwork is an arduous task. It's like a nightmare. You're asking for this, you're asking for that. And I agree. I mean, some of these people, some underwriters just actually think they're asinine. It makes no sense. But it just adds a different flavor onto a transaction. I'm refinancing a couple of my properties now, and a couple of conditions they're asking for. I said, well, I mean, where you been? I mean, you don't understand the business, and here you are, an underwriter. And these are all the things that kind of influence, people's perception about what it takes to refinance. And some people just don't want to jump through all those hoops in order to save $200, basically.
Yeah, it still baffles me that a lot of people still fall out. It's a big number. It's 18% of people who start mortgage applications actually fall out because of the frustration they have with the process. And that's unfortunate. There are mortgage shops that are widely available to people, and you see them every day as you drive down the street, that just don't know how to do mortgages, and they make it so hard when it really isn't. The technology is there. I still think you should get involved with your mortgage. Manage your mortgage. It was one of those kind of phrases I wanted to coin a while back, but somebody else took it. But you can manage your mortgage and make it part of your yearly routine, if at the worst, your yearly routine. Do you think that we saw the German yields go down? They're looking at stagflation now. Let's say we head into stagflation. Do you think that we could see interest rates or yields kind of take a pause and maybe go down a little bit and start helping people realize that, okay, this is a little reprieve. We know rates are eventually going to go up and continue going higher. But when we see those yields kind of dip, do you think that's an advantage? That's an opportunity for people to jump back in and say, I missed the boat, or maybe take cash out. We're looking at a lot of people who are considering equity line. Look, you have to remember, equities are still going up. There's a lot of equity to borrow on your house. And people are wondering, equity lines. Well, those are tied towards the prime rate. We already know the Fed is going to start raising rates, and it's going to affect the prime rate. We're going to see that get more expensive. Should we take money out? We just had the call from our friend that we've done many transactions. He has an equity line. He's thinking about fixing it and hedging against, because he has $300,000 on an equity line. Is this time to do it before the rates go up on those equity lines? There's a lot of things to consider.
And I think as the world changes, I think a lot of different options come out in the marketplace that weren't here when we were in one position. The client we're speaking of, he has a home equity line. He drew down some of it. It's a $300,000 value as far as the line is concerned. The investor that he has offered him to fix that rate at 0.5% higher for 10 years, which is not, when you look at the numbers, it's not a bad deal, because we know his rate is going to go up. And of course, he's an interest-only option. So I think it's a good deal. So I think what happens is, as we always talked on the show, is it's not rates that drive our marketplace. I think the marketplace is efficiently driven by programs. The more programs you have, the more people we can bring to the table, people who buy or refinance homes. We're seeing a lot of these programs now come into play, that what we call DSCR loans, debt coverage ratio, bank statement programs. All these type of loans weren't available a year or 2 years ago, or as popular, because there wasn't a necessity for them. But now as rates start to go up and things start to tighten, we need those options to continue the flow in the marketplace to keep the volume so we can keep people employed in our business.
I like how the what they call non-qualified mortgage market has really opened up to a lot of people who've what they call near missed that Fannie Mae and Freddie Mac and jumbo loan products, and they're aimed a lot towards investors, which we know that investors have really taken advantage of the market since the Great Recession. And they're always looking for ways to make some more profit, buy some more property, and stay competitive. That's the other side. Those are the people you're competing against as first-time home buyers, or any buyer for that matter. Well, we'll come back after this break. You can always chime in, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. This is the Real Estate Report on AM 1220. We'll be right back.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Just a lonely song.
Welcome back, and I'm the maestro, Gordon Hines, on this fabulous Thursday. The clock goes back on Sunday. What we spring forward? Because we came out of falling backwards, and now we're springing forward. A couple of years ago we moved that clock up. It used to be latter part of April. We moved it up like 6 weeks. So here we go.
Beginning of buying season.
Darker later. More days of sunlight.
What do you think the buying season is going to be like? A lot of people we're seeing the growth right now already. We saw an early spring season in demand. That is, we're seeing demand that as a days on the market as well as over asking price. All the stats that we keep talking about. Do you think we're going to see a really robust spring?
Yeah, I think so, because once again, there's still a lot of money out there. People are still looking to place money. People are still looking to do opportune buys. People are still looking to buy and flip. I get calls every day asking me if I want to sell some of any of the real estate I have, or if I know of any off-market deals. Those are the calls that come in. I don't know how to get my phone number, but I feel those calls here at the office and on my personal cell every day. So I think that there's still a strong, healthy demand for real estate, and I think it's going to continue throughout the year, regardless of the inflationary costs.
Yeah, I think that we're going to have a robust season, especially here in California. We're seeing a lot of people migrating. They're taking advantage of some of the new tax laws where you can move your all the counties are reciprocal when it comes to your tax basis if you meet the requirements. I believe it's 55 years of age and primary house to primary house, those types of things. I think we're going to see more and more people do that, and that's going to free up some inventory. I don't think it's going to be quite now. You heard me talk earlier in the show about inventory. Oh, we need more inventory. I don't think it's going to. We're going to have an overflow of inventory where we're going to have more homes than buyers. Even if we did, I still think that we aren't even close to the months of real estate that we normally would need of 6 months to be a balanced market. I think we're at 1, in most places. I thought this was a very interesting piece of news. A record 8% of homes in the United States are worth over $1 million or more. And that is up significantly. You go back to 2010, it was only 2%. 2020, it was only 4.8%. So since 2020 in February to February of 2022, it's gone up from 4.8 to 8.2% of homes in the United States that are over $1 million.
Well, I've seen some of the homes in some challenged neighborhoods go over $1 million. That would surprise the heck out of me if I was to, come out of nowhere. I mean, it just kind of caught me off guard. But once again, I think what happened is as the upper echelons of the real estate became not available, I think people became a lot more courageous and, bought in some of these challenged neighborhoods because, as we always say, there's no such thing as a bad neighborhood. It's the people in the neighborhood that are bad, and it's only a matter of time. You can change the dynamics of a neighborhood by just kind of changing the population. And we're seeing that all around the areas, and I think it's a good thing on one side, of course, and it's a bad thing on the other because somebody's gained and somebody's lost. But at the end of the day, neighbors start to improve, city services get better, crime goes down, people take pride, people are fixing houses up. Houses aren't depressed and dilapidated and drug infested like they used to be. And I think those all have, a shade on what direction the market's going to go. And I think we're seeing a lot of those shades go away simply because of demand for housing.
Take a guess on what state in the United States has the most $1 million plus homes.
I would have to say California.
California has 7 of the top 10 metros that have $1 million plus homes. San Francisco, 88.7 of the homes were sold for $1 million or more. Second place was San Jose at 85.9, Anaheim, Oakland at 55. Oakland at 55, does that surprise you at all?
No, it hasn't, because Oakland has been on the uprise. Oakland is a beneficiary of San Francisco. A lot of people cannot afford in San Francisco. They come over to Oakland.
Yeah, the Peninsula drove prices up in the East Bay significantly for that affordable housing. I remember looking at houses that were in the 400 or 500 range that are easily in the million now. They go Los Angeles 38.5, running up the top 10, Honolulu, Seattle, New York, and Oxnard at 31%. So,
and we've also seen loan limits that year in, year out have been increasing. We're probably pretty close to, we're over $750,000 right now on a loan limit. So if those loan limits push $1 million, we're going to see more $1 million evaluations in properties.
Yeah, and what Gordon means about that is that when Fannie Mae and Freddie Mac buy the majority of the loans, and when you fall into the loan limits, you have easier guidelines. So if you're buying $1 million house and you're putting 20% down, you're going to fall into Fannie Mae's guidelines. And that means you're going to have a lower credit score. You can have, lower reserves, a higher debt ratio. So we're seeing more and more people be accommodated by these higher loan limits that fall into Fannie Mae and Freddie Mac. And then you have the jumbo. A lot of these lenders are bringing out jumbo products that are accommodating people up to 1.5 or 2 million. You can have they've dropped. I saw one jumbo loan where you could do 660 credit score. If you're a first time home buyer, you might need a 680 or 700, but they're really, when that used to be a 740. So there's a lot of products that are continually pushing this market. It's not just the products, though. It's the way that they're setting up these guidelines. Lenders are, I don't want to say desperate, but it's a competitive market. Everywhere you turn, especially for us to see it, everywhere you turn, there's a new lender, Everywhere you turn, we get phone calls 10 times a day, lenders trying to earn our business. That's the nature of the business right now, is to try to earn your business. We've talked before, and maybe we'll save this for the next show. We're running out of time, about at what point do these lenders just say, you know what, we're going to take what we got because we don't want to push the limits anymore. We just talked about that, not 5% down jumbo product, which does and doesn't make sense. And I see that as something that maybe you would take advantage of in a short term, but not long term. There's a lot of products that might start looking risky and really pushing the envelope. And that's what we really want to be careful. That's how we got into the mess in 2010, the last big recession. Thanks for joining us. You can always reach us Facebook and YouTube. It's Bay Area Loan Source, all one word, Bay Area Loan Source. You can always go to our website, add a .com at the end of that. You can always email us, Tony or Gordon at bayarealoansource.com. It's Tony or Gordon at bayarealoansource.com with any of your questions. Thanks for joining us. We'll see you next week. I'm Tony Mendes. That's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW.